Welcome to the 83rd episode of Kanga Crypto News, your weekly hub for swift, trustworthy coverage from across the crypto landscape. I'm Cboe, ready to deliver the freshest developments and the stories that matter the most. New episodes go live every Friday. If you want to keep up with the most important moves in crypto, make sure to subscribe and tap the notification bell so you never miss an important update. But now, let's jump in. So let's start with Solana because Wall Street just gave it a dedicated on-ramp. VanEck launched the VanEck Solana ETF, a spot-style product that holds SOL and passes through staking rewards to investors. There's a launch promo, zero sponsor fee and zero staking provider fee on the first $1 billion in assets, or until February 17, 2026. After that, VSOL charges 0.3% with the higher rate kicking in on any assets above $1 billion before the deadline. Over in Saylor land, Strategy doubled down on its just keep buying script. The firm picked up over 8,000 bitcoins between November 10th and 16th for about $835 million, paying an average price of $102,000 per coin. That pushed its total stash to 649,870 BTC, with an average entry of $74.4 thousand. The buy was funded via a suite of preferred stock, STRF, STRC, STRK, and STRE, with the euro-dominated STRE raising roughly $715 million from European investors and STRC adding $131 million. That move also served as a live fact check. Online rumors claimed Strategy had sold billions in BTC after large wallet movements, but analysts traced the flows to custody reshuffling rather than dumping, and Saylor came out to say, "We are buying." All of this fits into Strategy's 42/42 roadmap and $84 billion war chest for BTC accumulation by 2027, backed by around $8 billion of debt, but so far no signs of forced selling pressure. If Strategy is the Bitcoin whale, BitMine is trying to become Ethereum's. Tom Lee's BitMine Emergent Technologies reported $11.8 billion in combined crypto and cash, over $600 million in cash, and over 3.5 million Ethereums. That Ethereum hoard gives BitMine control of about 2.9% of the circulating supply, halfway to its stated alchemy of 5% goal. In his November chairman's note, Lee argued that this cycle's peak likely sits 12 to 36 months away later than prior 4-year pattern and blamed recent post-October 10 weaknesses on one or more market makers nursing balance sheet holes, creating a kind of crypto QT that could last 6 to 8 weeks. BitMine's pitch leans on long-term accumulation, high stock trading volume, 48th most traded in the US with $1.4 billion 5-day average, and strong backers like Cathie Wood and Bill Miller. On top of that, Lee framed tokenization and laws like the proposed Genius Act plus the SEC's Project Crypto as the next big unlock for transparent markets, likening it to the post-gold standard modernization of Wall Street. On the derivatives front, Cboe is bringing offshore-style perp vibes into US regulation. The exchange plans to launch continuous Bitcoin and Ether futures on Cboe Futures Exchange from December 15, 2025. These contracts run for up to 10 years but feature a daily cash funding amount, so prices track spot closely, giving institutions perp-like exposure without the constant headache of rolling expiring futures. They are cash settled, cleared through Cboe Clear US under CFTC oversight, and can be cross-margined against existing Cboe, BTC, and Ethereum futures. Trading runs 23 hours a day, Sunday evening through Friday afternoon US time, and Cboe is lining up educational webinars in December and January to walk investors through mechanics and use cases. The message is simple: perpetual-style crypto futures, but wrapped in the familiar rules and protections of a US exchange. In tokenization land, BlackRock's BUIDL just got a bigger playground and a serious use case. The $2.9 billion institutional digital liquidity fund, backed by US Treasuries and targeting roughly 3.7% yield, is now live on BNB Chain. Thanks to securitized and the wormhole interoperability protocol, BUIDL can already move across chains like Solana, Polygon, Arbitrum, and Avalanche, and BNB Chain is the latest stop in the multi-chain push. Binance has added BUIDL as eligible off-exchange collateral for institutional setups like Binance Banking Triparty and Mirror RSV, letting traders park tokens with a third-party custodian, use their value as collateral to access Binance liquidity, and keep earning yield without selling. For big players, that effectively turns collateral into a revenue-generating asset that can offset fees, making trading close to cost neutral. The broader takeaway: tokenized treasuries are no longer just a demo, they're becoming core plumbing for how institutional capital moves into around crypto. Back in the ETF land, 21 Shares is testing whether US pros want crypto bundles, not just single coins. The Swiss asset manager launched 2 multi-coin ETFs under the 1940 Act, FTSE Crypto 10 Index ETF and 21 Shares FTSE Crypto 10X BTC Index ETF, with fees of 0.5 and 0.65%. Instead of holding tokens directly, the funds gain exposure via 21 Shares' existing European ETPs, giving US investors a regulated wrapper that tracks a basket including names like Ethereum, Solana, and Dogecoin. President Duncan Moore pitched 1940 Act funds as the gold standard for professional allocators, suggesting these diversified products will appeal more to advisors and institutions than retail traders who prefer single coin ETFs. The launch comes in a choppy market, with Bitcoin dipping below $100,000 for the first time since June, and investors taking profits, but 21 Shares expect steady inflows as more pros admit they don't know which coins will win and would rather own the index. It also marks the first time a multi-coin crypto ETF in the US uses the 1940 Act structure, stepping beyond earlier 1933 Act products from Grayscale and Hashdex. On XRP, the long-teased US spot ETF finally crossed the starting line. Canary Capital launched the Canary XRP ETF under ticker XRPC after filing Form 8A, positioning it for a NASDAQ listing while structurally mirroring the US spot Bitcoin ETFs. XRPC is a grantor trust that holds real XRP with US bank handling, cash, and Gemini Trust plus BitGo Trust acting as digital asset custodians. The fund tracks the CoinDesk XRP CCIX New York rate, a 60-minute time-weighted benchmark, and creates or redeems in 10,000 share baskets with a 0.50% sponsor fee. Initial NAV of $25 and about $5.25 million in starting assets. It sits outside the Investment Company Act of 1940 and doesn't operate as a commodity pool, putting it in the same regulatory lane as BTC spot ETFs. XRP was trading around 2.4 to 2.45 ahead of launch, with intraday volume up 53%, and the big questions now are how XRPC handles volatility, how fast rival issuers respond, and whether institutions embrace an asset with a messy legal history but a long-running role in cross-border payments. Meanwhile, Jack Dorsey's Cash App is trying to become a full-stack money OS with a crypto twist. In its Cash App release, Block rolled out 11 new products and over 150 upgrades spanning banking, Bitcoin, P2P payments, and automation. The headline feature is instant Bitcoin payments over Lightning. Users will soon pay with BTC for free in seconds and later even settle Lightning invoices in US dollars without holding BTC at all. A Bitcoin map helps users find nearby merchants that accept BTC, while upcoming stablecoin support lets eligible customers send and receive digital dollars inside the app. On the fiat side, Cash App Green redefines account benefits for the roughly 40% of users without traditional direct deposits, unlocking perks like no ATM fees, overdraft protection, higher borrowing limits, and better saving rates for those who deposit $300 or spend $500 per month. There is also Cash App Borrow for loans up to $500 in 48 states with reported payment rates above 97%, tighter afterpay integration, teen accounts with up to 3.5 APY, and parental controls, an AI assistant called MoneyBot to surface insights and nudge users into action, plus beefed up fraud defenses that Block says have blocked over $2 billion in scams and refunded $8 million to 80,000 users since 2020. Finally, Ethereum took a hard look in the mirror with the Trustlessness Manifesto. Vitalik Buterin, Yoav Weiss, and Marissa Posner used the document, permanently stored in a smart contract of a simple pledge function and no admin keys, to restate Ethereum's core mission. Let people coordinate and transact without depending on intermediaries. The manifesto warns that centralization often arrives disguised as convenience. Hosted nodes, whitelisted relayers, centralized sequencers, upgrade keys, and that each small shortcut can tilt power towards landlords who control access. Trustlessness, they argue, means anyone can join, verify, and act without permission. No critical secrets sit behind the system, no irreplaceable middlemen exist, and every event is publicly verifiable. The authors cite examples like an AWS outage that cut basis throughput by 25% due to a single cloud sequencer, contrasting it with more resilient multi-cloud rollups, and compared today's risks to how email quietly centralized over time via spam filters and block lists. Developers are cast as stewards, not rulers. Every convenience feature is a potential choke point, and the goal is a system that fails publicly and recoverably rather than silently and opaquely. The manifesto doubles as both warning and roadmap for keeping Ethereum open, neutral, and genuinely trustless, as complexity and pressure to centralize grow. Taken together, this batch of news paints a clear picture. ETFs and treasuries are institutionalizing crypto exposure. Tokenized treasuries and new derivatives are rebuilding market plumbing. Fintechs like Cash App are blending BTC and stablecoins into everyday finance. And Ethereum's core devs are trying to make sure the base layer doesn't quietly centralize while all of that happens on top. That's it for today's Kanga Crypto News. If you enjoyed the episode, please like, share, and subscribe to stay current with all the latest news. As always, stay informed and stay ahead in the blockchain world. See you next time.
We are Kanga, beyond crypto.